Hello. Hi, I'm Mark, and I will be teaching the class. And I think I sent out the syllabus. It's also in Blackboard. Is there anyone that did not get it? Okay, we'll go over the syllabus first, and then jump into the fun stuff. Oops, where am I at? Here we go. It keeps doing this weird preview thing that blocks part of my screen. And it's kind of funny because it shows exactly what's on my screen. Anyway, my problem, not your problem. This is the syllabus. You probably already have it. The textbook is a really good textbook. Whittington and Panny. This is you can any form of it's fine, by the way, for this class. You don't have to have the Connect or anything like that. But it's a really good textbook. The authors of this textbook, they also write the Wiley CPA exam review. So it very closely follows the CPA exam. If you're studying for the CPA exam, this is the auditing book to have. And especially for things like the sampling and stuff like that, it's identical, pretty much what you'll see on the CPA exam, whereas a lot of the other books are not. So anyway, that weird preview screen again. Well, let's jump down here. Okay, assignments, course requirements. The assignments and textbook problems are 20% of your grade. Assignments and textbook problems are assigned for each chapter. And they're emailed and available in Blackboard. The exams are different. The exams are only emailed to students. So they'll be in your email. So they're only, you'll not find the exams in Blackboard. And a logical question is why? And that is because there'll be different, you'll have there's different forms of the exam. So you have to turn in the exam that was sent to you. So there's only one exam for each student. So it'll be emailed to you rather than Blackboard. Okay. Submitting work. All assignments, blah, 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 need to be submitted in Blackboard. Usually assignments are due 1 week after they're assigned. I'll show you this in a second. The grades for the assignment will be included in the grade to date calculation after the due date. And late work is accepted without penalty. So this is actually an important one here. However, the grade to date will show a 0 for missing work until it's turned in. So in other words, you can turn in late. If you miss a deadline, don't think you can't turn it in. You can. However, your grade's going to look bad until you do, because it's going to be a 0 factored in there. And let me go ahead and kind of show you what I mean in the assignment thing. Go to Blackboard. So in Blackboard, I think it's like the second one down on yours. It'll be the assignment and work submittal. And here's kind of let me see if I can zoom in here a little bit. I don't know why I put this in. Textbook problems are in your textbook. You guys probably knew that already. I'm not sure why. And when you're done with the assignment, you can turn it in. This is just going over the same thing that you have in your thing. It's email. Exams are emailed to students. So how do you turn in the assignments? Well, completed original documents. So if I send out an Excel or Word or a PDF, if you fill it right in on that document and then submit it, that's fine. If you want to print it out or use notebook paper, you can scan it. Or If you you either complete it from the documents, or if you use notebook paper, which is absolutely fine, you can take pictures, and you can take lots of pictures. Files that are not allowed: zip files and page files. Zip files are on Windows, page files are Apple. So if you take a bunch of pictures, that's absolutely fine to submit those pictures. You can submit 10 pictures. But it doesn't like zip files, and it doesn't like page files. For whatever reason, Blackboard can't read them. I wish it did, but it doesn't. So anyway, don't do zip files or page files. Well, if you take 10 pictures, just submit 10 pictures. Well, here, I'll show you. Look how I like it. So this is the first, this is our assignment, the first assignment. I already goofed it up. No. Okay, so here it is. There's the first assignment. There's the files that are attached, same ones. There's the due date. It's due on February 3rd. And then the submission details, unlimited attempts. So you can put in 10 files if you want. And the highest grade is taken. And that's, what's going on here? I goofed something up. Okay, so here's the assignment down here, with the due date and all that. So this is kind of just tells you like how to turn it in. And so this is our first one. It'll be due Friday, a week from this Friday, right? Yeah. So those will all be in there, and the files will go along with it. The only ones that won't be in there will be for the exams. Okay. Question on that? All right, back to the syllabus. Submitting work. This is all the date stuff. You guys probably already have this. If you need to drop the class, hopefully you don't, but if you need to. And the exam, and there's our beloved grading scale. Okay. The one thing that might cause confusion is this first one here. Audit sampling, chapter 9 exam. Audit sampling will be done throughout the course. It'll be there's 5 handouts we go through, and then there's the exam on it. And it's good to break it up. Plowing through it all at once is not, well, it's not a good way to learn, because they all kind of start looking the same, but also because it's also good to kind of break up these classes so that you go through a little bit of definition-y text stuff, and then you do a little bit of number stuff, which as accountants, most of us are a little comfortable with. And today we're going to start out with chapters 1 and 2. And I'm not sure when we'll have the exam on that. It should be probably like week 3. I would send it out, but I'll see. We'll take a look at it. I'll look at it. Okay, so yeah, this is just so you can kind of bounce along here. And when we finish a chapter, we have a test on it, basically. Yeah. All right. Any questions on this?
I have one question. I did purchase this is Lynette speaking, by the way. Hi, Professor. I did purchase the Connect prior to the class starting. Is that okay still, or no?
No, you can. There's nothing wrong with having it, and there are some extra features and stuff that they have. Just for this class, you don't need it. So if you there's nothing wrong with it, and there's a link there for the ebook, to get into it. But if you don't need it, it's if you want to, you can return it. You should be able to, anyways. And like I say, it's it doesn't matter to me which form of it of the textbook you get. You'll see that in this class, and one of the reasons why I don't use it in the auditing classes is that so much of this stuff is kind of written, and it doesn't. A lot of times the materials, especially the book problems and things like that, you're doing a lot of just typing the stuff in anyways. So a lot of times we just do it by hand. But there's nothing wrong with having it, and there are some extra materials on it, and it is an excellent book. Like I say, the same authors that do this book do the Wiley CPA review, so it is a packed book.
Thank you.
Yeah. Any other questions? Yeah, and now there is another class that also uses this book, and that's the graduate class, the 433. And depending on who you have for that class, they might require you to have the Connect. So if you are going to take the 433, and it's not me, they might require you to have it. So
Okay, understood. Thank you.
right. All right. So let's go to actually two things I'm going to pull up here. Let me get rid of that and go to chapter 1 and 2 handout. And we'll talk a little bit about this, and then we're going to go to the one of the other handouts. But I want to talk about just basically what we do for auditing. And this class focuses very heavily on the type of auditing we call financial auditing. That's when a company puts out their financial statements and auditors will go audit those financial statements. That's kind of what a CPA does. That's what a CPA license allows you to do. So that's what we kind of focus on in this class. There's other types of auditing and that sort of thing, but in this class, we're going to try to focus on that, and that's really what the CPA exam is focused on. And even if you're not planning on becoming a CPA, it's a good idea to know this stuff, just because the AICPA is a really important. It's the biggest, it's the most powerful organization for accounting in the U.S. And usually, what they say is something that that matters. I'll put it that way. Okay, so these are just really basic steps when it comes to doing the audit, and we're going to look at these more in depth later on. But change this back to the first step is that you get a client, and that might sound really easy, but as auditors, we don't just take anybody as a client. We have to be independent from them so that we can do the audit. They have to have integrity, and there's some other things that go along with that. And so getting a client is actually a little more complex than it might sound. Once we get a client, we then have to go gather information to see if their financial statements are not materially misstated, or if they are materially misstated. We're looking for material misstatements, and we'll talk about those in a little bit here. And then the last step is, once we get enough evidence, we're going to use that evidence to give an independent opinion. And this is very important. Okay, so an independent opinion is what we're really, hey, what did I do here? Okay. All right, at this point, let's open up. There's a handout on the IBM Financial Report, and let me pull that up on my screen. Okay. So this is the IBM Financial Statements. This is from 2020, which is about a year old. They usually lag about a year or so. So yeah, this will be from 2021. 2022 ones are not out. So here are their financial statements. So this is the income statement. And they show how much revenue they have. And down here, they show how much income they have. Okay. Now, here's the problem with these financial statements. These financial statements are made by IBM. The auditors do not make the financial statements. IBM makes these financial statements. So how do we know these financials? So here's the income statement. Here's a balance sheet. Here's the assets, total assets, current assets. Oops. Here's the liabilities. Statement of cash flows. So here are these are the financial statements. And how do we know that we can rely on these numbers? You know, when they say that they had sales or revenues of, well, they're in millions, so that's 73 billion. Well, how do we know? How do we know that IBM isn't just making that number up? You know, how do they know that they're not doing something with the books either to make themselves look better or worse? Sometimes that happens too. But how do we know that those can be relied upon? You know, and notice that, you know, as us as investors, we don't have any inside knowledge about what the company's doing. So the need for audits is that somebody has to go in and say, okay, you say you have 73 billion in revenue. How did you get that? And then they'll go through and find evidence of that $73 billion. And the evidence, to be evidence, it either has to corroborate or refute that the 73 billion is good, right? It has to be one or the other, either, or it's not evidence. So an evidence will either say, yes, the 73 billion is fairly presented, or no, it's not 73 billion, it's 64 billion or whatever it is. So we gather evidence to see about that. And coming down here near the bottom of this is the report that gets issued. And the big thing here is that it is independent. So they are independent from the company. And basically they'll send this out, and it's generally to people who are not in the company itself. You'll notice that they sent this out to board of directors and stockholders. And, you know, they did not send this report back to IBM's management. Why? IBM management are the ones that made it. So you're not issuing this report for IBM's management. And this is another thing that sounds kind of strange, is that when you're doing an audit, a financial audit, your client is really not who this is for. I mean, this isn't helping IBM. IBM already made the financial statements. They already know that it's 73 billion. It's people on the outside. You know, you're helping them by giving credibility to the financial statements, that people on the outside can rely on them. You know, and that's it. I mean, that's all it is that to help the other people on the outside know that the financial statements can be relied upon. So your client is not necessarily the group that you're trying to help. You know, you're trying to help people on the outside to do it. And that's another thing about auditing that's strange, is that your client, you must be independent from the client. That means you can't own stock in IBM if you're doing an IBM audit. You're not independent. You can't promote IBM. You can't be an advocate for IBM because you wouldn't be independent. You have to be independent. So it's one of those weird things that you can't be related to your client. And I'll talk about that, how kind of strange that is when you talk about the CPA exam and the license and all that. All right. So first paragraph here, they just said that we audited the financial statements, you know, balance sheet, statement of income, blah, blah, blah. And then here is, in our opinion, the statement of revenue reflect present fairly in all material respects. The financial position is just another term for balance sheet. You might ask, why don't they say balance sheet? Well, I don't know. They don't. Results of its operations. Operations is same thing as the income statement. And its cash flows for each of the years and then ended, blah, blah, blah. Okay. So a few things here. Notice this all material respects. This brings up what is material to, for the financial statements. They don't give a dollar amount. They say all material respects. So what is material? Is $5 million material? If you're doing an audit, well, what would make it material? Maybe is a better way to say it. And let's say you came up with an error that was $5 million. Is that material? What does it depend on?
Inventory?
Could be. Could be. Inventory can affect a lot of things. It can affect your income as well as your assets and all that. But as far as the $5 million amount, well, let's go back to IBM. Is it material to IBM? Where am I at here? Hold on a second. Would this be material to IBM? How much of a difference would this make? Instead of being 73,620, if it was 73,615,000, would that matter? Is there someone that would say, whoa, wait a minute. I was thinking it'd be 73,620,000,000. It's only 73,615,000,000. Oops. $5 million would not be material to IBM. It wouldn't make any difference as far as their financial statements go. It's too small. You're talking about tens of billions. To be off by 5 million is not going to be anything. And here's another thing about auditing. You wouldn't even be looking for $5 million misstatements if you were doing an audit of IBM. It's not material. Even if you found one, it wouldn't matter. So you would only look for things that are material. Now, I don't know what they use as materiality for IBM, but I'm sure it was more than $5 million. So it depends on the size of the company. Now, a small company, let's say that they had 20 million in sales and it was off by 5 million. That's huge. That's like go to jail huge. But IBM is just so big, the numbers are so big that $5 million really doesn't make that much difference. And because it doesn't make that much difference, we don't even look for it. And every now and then you'll find people say, well, the auditors missed this. Someone was embezzling $1 million a year and the auditors didn't catch it. Auditors, if it's a large company, auditors weren't looking for it. And it probably would have cost more than $1 million a year for them to look for it. Okay. So going back to this audit report, part of the audit report is we kind of explain what we do. And there's two really important little snippets here. And that's down here near the bottom of page 6. We don't give absolute assurance. We give reasonable assurance about whether the financial statements are materially misstated. So, reasonable assurance. Do we give absolute assurance? No. We don't. We give reasonable assurance. And we're only looking for material misstatements. So we never claim that the financial statements are accurate. We only say that, look, if you're a reasonable person, these financial statements can be relied upon. They're free of material misstatement. So again, reasonable assurance, material misstatement. And we also tell them, look, we don't look at everything. We look at things on a test basis. Not all the time, but sometimes we look at things on a test basis. Sometimes you have to. For instance, if you're auditing Walmart and you're doing the inventory, if you want to do the inventory at year end at Walmart, it would be impossible. There's not enough auditors in the world to do it. They have too many locations. They have to, auditing, you have to have people on site, and they have thousands of stores, and it would just be impossible to actually do 100%. You have to do it on a test basis. It's not possible. Same thing, like for instance, like medicines. When they come up with a new medicine, you can't get all 7 billion people on the planet to take the medicine and see what happens. So they take a small group and they go, okay, let's see what happens to this group, and then they think, okay, well, it helped 32% of this group, so we think it'll help 32% of the big group, or whatever it is. That's where the statistics stuff comes in. Okay. And down here it tells who they are. PricewaterhouseCoopers. It's a big firm. And I just goofed it up. Just made them look like a small firm, but they're not. They're big. And this is they've been the auditor since 1923. Kind of interesting. All right. So anyway, so this is the audit report. Back in the good old days, we used to have to memorize that, because sometimes they'd have in the CPA exam write the independent auditor's report. You would write it, or if you had to memorize, you'd write it, and you'd always memorize it, because then you'd know that you'd pass, because it would, like, half the people wouldn't memorize it, and so if you memorize it, you passed. Different now. So anyway, they don't have you memorize stuff like this now. Okay. So let's go back to, I'm gonna get rid of this. So let's go back here. The demand for the audits. IBM needs an audit to assure the shareholders that the financial statements can be relied upon. Okay, so this is why there's a demand for audits. So, question number 1, what do independent auditors provide to the financial statements?
D.
Credibility.
No,
B.
D as in dog.
B, yeah.
Oh, D is dog. We don't give absolute assurance. We give reasonable assurance. We do give it insurance, but it's reasonable. What we give is credibility. That that the financial statements can be relied upon. We never say they're accurate. What we just talked about, IBM, they may be off by $5 million, and the auditors didn't care. We don't give any additional knowledge to the financial statements. The only thing we give is credibility. And again, the credibility comes from us being independent. And and here's another thing: auditors don't necessarily Sorry, back my mouse. Auditors aren't necessarily experts on the company. They're people inside the company that know a lot more. If there's somebody in IBM, believe me, the people in the accounting department and the auditing department, internal auditing department at IBM, financial people that know way more than the auditors know when they come in. But they're not independent. They work for IBM. So this independence is huge. You have to be independent from your client. All right. So that's a kind of a, it's sort of like somebody going in for other people and taking a look at the financial statements. So even though IBM is called us in for the audit and they're paying for it, the credibility is what we really give to the financial statements. Okay, business risk. This is a risk that a company will go bankrupt. Oops. So business risk is the risk that a company will go bankrupt. It's the risk of being in business. Information risk is a risk that an undetected material, misstatement will appear in the financial statement. So information risk is a risk that an undetected material misstatement will appear in the financial statements. Now think about that audit report. In that audit report, did it say anything about IBM going bankrupt? Hey, wait, that's my insurance is wrong. I'm sorry. What type of risk are we more concerned with as auditors?
C.
We are somewhat worried about that.
B.
Yeah, we're information risk. And by the way, risk of fraud is included in the information risk. We are worried about fraud, and fraud actually is something we are required to look for. But it's included in the information risk. It could also be a misstatement due to error. So it's not just fraud, but fraud is certainly part of it. Oh, by the way, another thing about CPA exam questions is that the actual instructions they give you is to pick the best answer, not necessarily the correct answer, because there might be more than one correct answer. I know, and that's also part of the fun of taking the CPA exam. That's part of why 75% passes. Okay, so yeah, we are concerned about risk of fraud. Risk of fraud, though, is included in the information risk. So we're really worried about this. And by the way, if a company is going bankrupt, can they still make their financial statements accurately? So let's say they're doing poorly. Is it still possible for them to make their financial statements? Yeah, they can make them. They can do their financial statements correctly and get a clean audit, even if they're going bankrupt, because the financial statements will look bad, but they can definitely do it. So you can have financial statements that are free of material misstatement if you're going bankrupt, and get a clean audit. Another thing about the audit is it's not a stamp of approval for the company. Some people will look at it and say, okay, they got a clean audit. That means it's a good investment. Doesn't mean that at all. It just means the financial statements are free of material misstatement. And even if they are a very successful company, it still doesn't mean that they're a good investment. Maybe their stock price is way too high. just because they're doing good doesn't mean they're doing that good. Maybe their stock price should be around $60 and it's at 80. Well, it's a terrible investment. It's overpriced. So even if the financial statements are not materially misstated and the company's doing very well, it might still be a bad investment. So we never say that they're a good investment or a bad investment. All right. You guys know most of the stuff already. Board of directors are oversee the corporation. We term this as governance. In auditing terms. And so when they talk about someone who's in governance, they're talking about board of directors usually. Audit committee is a little bit different. Audit committee is for publicly traded companies, they are independent directors, and they are a subset of the board of directors. Now, you might want to say, what does this independent directors mean? There are people on the board of directors that will also be working inside the company. It's not uncommon to have the president of the company who's running the company day to day. It's not uncommon to see the president of the company also on the board of directors. Right? That is not an independent director. Right? So independent directors are people who don't work at IBM, but are on the board of directors to help guide them. They could be large stockholders or something like that, but they do not work inside the company. So the independent, the people on the outside of the company, are the ones that can be on the board of directors for a publicly traded company. Any question on that? And by the way, not all companies have board of directors, but publicly traded companies, if you can buy their stock, they must have an audit committee on their board of directors. So it's publicly traded, and we'll get to the distinction here in a little bit. It's publicly traded, they have to have an audit committee. If they're not publicly traded, they don't. I think I'm going to skip the types of audits. And I'm going to skip the types of auditors. We don't need those for now. Let's skip down to G. What time is it? This is kind of dragging. AICPA. AICPA is the American Institute of Public Accountants. The ACCT330 is just a club. That has CPAs for members. When you pass a CPA exam, they'll send you a letter saying, hey, we noticed you passed the CPA exam. You want to join our club? And you can join the club or not join the club. Now, the AICPA does a few different things. They make the rules for auditing. Well, let me back up. They make the rules for accounting. FASB. You don't need to know that. They do rules for auditing. That's the one below ASB, Auditing Standard Board. And they also create and grade the CPA exam. Now, the AICPA is not a government agency. It's a club. All right, so if you think about it, the fact that it is just a club, well, who cares? It's like the Boy Scouts. Boy Scouts say you have to do this. Well, I don't care. I'm not a Boy Scout. I don't care what they say. Well, the AICP actually carries quite a bit of weight because government agencies often refer to them for making laws and for other people that they are overseeing. They'll say, by the way, this club over here called the AICPA, you have to follow their rules. So while the AICPA is not a government agency, they have no, I don't say valid, but they have no direct authority over anybody. However, they have this indirect authority, in that government agencies like the Securities and Exchange Commission or state boards of accountancy will say, you have to follow this club, they make these rules and you have to follow their rules. And sometimes states will make them into laws. They'll say, oh, they have this rule that says this, it's going to be a law. So a lot of times their rules will be laws in states. So the AICPA actually is pretty influential, even though they have no direct power over anybody. They also make the CPA exam. They make and grade the CPA exam. And every single state uses their exam. They don't have to. It could be the state of Illinois wakes up tomorrow and says, look, we're going to make our own CPA exam. This is what we're going to, they could do that. But they don't. Every single state uses the AICPA CPA exam and they grade it. And I don't see that ever changing, at least not in near future, in my lifetime probably. But anyway, so the AICPA actually is a very influential organization. Not directly they can't do anything, but indirectly they are very powerful. Okay, and we always talked the AICPA, the standard board is aids make the rules for auditing. And we just talked about the CPA exam. So, well, yeah, we'll put it in writing. This one in the they makes the rules for auditing. Probably a better way to say that, but in the CPA exam, the CPA exam is used by every state to license CPAs. State boards of accountancy. This is the group that actually issues So the AICPA does not issue CPA licenses. The federal government doesn't. State boards of accountancy do. So, Illinois, Wisconsin, you get the idea. Oops. All right. Yeah. So think about this for a minute. If the AICPA doesn't issue the license, can they revoke the license?
No,
No, only the state can, just like a driver's license. The AICPA can no more revoke your CPA license than they can revoke your driver's license or any other license. They have no power over it. Only states can revoke licenses. Only states can issue them. Only states can revoke them. The federal government cannot revoke your license. Only the state can. So it's whoever issues it can revoke it. Just like your driver's license. Only the state of Illinois can revoke your Illinois driver's license. Same thing. Okay, Securities and Exchange Commission. Issuers. And by the way, this is the terminology they use. Issuers are publicly traded companies. So companies that are on the stock exchange, things like that. And they must follow SEC rules. The Exchange Commission is kind of like Big Daddy. They're like the ones that people are afraid of. Non-issuers are privately held companies oops. Oh. Non-issuers, these are privately held companies that are not under the jurisdiction of the SEC. And it's kind of one of those things that's a little bit ironic in that privately held company, you take IBM, if the SEC says something, they have to do it. If the SEC says, these are the rules, you got to follow them, IBM has to follow it. Joe's hot dog stand that isn't publicly traded, the SEC has no power over Joe's hot dog stand. Joe can do whatever he wants, and the SEC can't do a thing about it. So you get, if it's publicly traded, then the SEC has jurisdiction. If it's not publicly traded, they don't. They have no control over privately held companies or businesses that aren't companies. They have no jurisdiction over them. All right. I think we'll do L, and then we'll well, company and 5 and 6, and then we'll take a break. Publicly traded company oversight board, the PCAOB. It's a newer organization. I wish they found a better whatever. Anyway, so the PCAOB, they oversee they do other things too, but oversee for us auditing of publicly traded companies. Also known as issuers. So it's part of the SEC. It's underneath the SEC. And they oversee the auditing of publicly traded companies. Commonly called reporting, but they yeah, they're an oversight board. This came out of the Sarbanes-Oxley Act. Oops. In the Sarbanes-Oxley Act, I don't know if you guys have talked about this. This is after there was big fraud. Enron. WorldCom. Oops. What am I doing here? I'm doing crazy thing. Okay, here we go. WorldCom's one word. You guys probably, I don't know if you guys talked about the other classes, but Enron was a company that had it was like the first $1 billion fraud that we had in the United States. And then WorldCom came about a year later. And no one had ever heard of that. Before Enron, like a big fraud was, $50 million. It was a $50 million fraud. That was like the huge thing. And Enron, that it was off by billions. And, the auditors knew about it. And Arthur Andersen was the big CPA firm back then, the biggest, and the one that everyone wanted on their financial statements. And they were associated with Enron. And after Enron, it sunk the largest CPA firm. Before Enron, everyone wanted Arthur Andersen's name on their audit report. It was really a prestige thing. After Enron, you couldn't have Arthur Andersen's name on it, or no one would believe it. So it literally was an audit that sank and in the largest CPA firm in the United States. And then when it started to cool down after that, they thought, okay, well, this just happened. This is just a one-time deal. Then the WorldCom one hit. WorldCom was even bigger than Enron. And after that, no one believed the financial statements. So they came up with the Sarbanes-Oxley Act. The Sarbanes-Oxley Act was an act they couldn't get passed for like 10 years. And corporations were so desperate, they said, okay, just pass this act and then we will, because we need to get people back that can trust our financial statements. So that's how Sarbanes-Oxley came. It was actually one of those acts that was actively suppressed by businesses. And then, within a year, that turned around completely, and they, endorsed it because they had to. No one would believe their financial statements. Okay, let's do 5 and 6, and then we'll take a break. Which of the following organizations can license a certified public accountant? Anyone? You can put it in chat if you want.
The first one?
Nope.
B.
Yep. Now, they'll make the exam, but they don't actually issue the license. So the ICPA actually makes the exam, but the state is the only one, just like a driver's license. When you think about licensing, it's just like a driver's license. Which of the following state organizations can revoke a license?
B.
Yep. Yeah, it's just like a driver's license. Now, the only thing that the CPA license does is it allows you to write that CPA report. And by the way, in most of your classes, they tell you don't plagiarize anything. You can't plagiarize, it has to be your own words, blah, blah, blah. When you're in accounting, you must plagiarize. If you don't plagiarize that standard boilerplate opinion, you can lose your license. So only CPAs can use that. It's actually copyrighted. You can only CPAs can use the that standard audit report, and they must use it. So it's one of those weird things, but the license gives you the ability to use that report. And that's all it does. This is to write that whatever 6-paragraph report. That's what a license does. Question on that? Okay, let's take a break. Let's say be back. Let's see what's 10 minutes from now. What's 10 minutes from now? 6:56. Let's say be back at 7:06. Oops. Okay. Okay, let's go through this. All right, CPA firms. CPA firms come in all different sizes. And generally speaking, the size of the CPA firm matches up to the size of the client. A smaller CPA firm will have smaller clients, and a larger CPA firms have larger clients. And the reason for that is, for instance, let's take larger clients. You know, IBM has offices all over the world. If you're going to do an audit of IBM, you need to have a CPA firm that has offices all over the world. So they generally the smaller firms will have smaller clients, the larger firms have larger clients, and the stuff's in between is, stuff's in between. Okay, local firms. Usually usually 1 to 10 partners. One of the things that they do a lot of non-auditing work. It's not unusual for them to do taxes, bookkeeping, that sort of thing. They'll do audits, but a lot of times it'll be things like taxes. That's nice about taxes. Regional firms. Usually say 5 to, I don't know, maybe 25 partners. And they will usually cover more than one state. For instance, it's fairly common to have regional firms in this area that will do, a regional firm might do Illinois, Wisconsin, Indiana. There's a lot of business done around those areas, maybe even into Iowa. But they'll usually span kind of a region, because a lot of times there's businesses that are regional. So if you have a company that is growing, maybe they have business in Illinois and Wisconsin, well, one of these firms would be the place to go. National firms. Oops. Usually say 50 plus partners. Oops. And they usually cover most states. And the big 4 firms, they can have thousands of partners. Well, let's say, I don't even know, right, 500 plus. That's probably low. Hey. So the big 4 firms, we're talking about the United States, the big 4 firms. And this is what they are: Deloitte, PricewaterhouseCoopers, KPMG, and Ernst & Young. And they can have thousands of partners. And again, usually, the size of the company matches up with the size of the auditors. Okay, so number 7. Which of the following types of CPA firms would be appropriate to perform an audit of a bakery that has operations in Illinois and Indiana?
B.
Probably B, yeah. And now you might say, well, gee, certainly a national firm or an international firm could do it, right? I mean, you could get a national firm or an international firm to do it. Usually the fees go up quite a bit as you go up those different levels. So in an audit is to some extent generic, in that, once, the independent auditor's report, first of all, it's exactly the same wording that you'd get anywhere, because you must use that wording. So a lot of times, there's nothing wrong with going with a regional firm. If, why pay, if you pay 70,000 for an audit from a regional firm rather than 170,000 from a national or international firm, it doesn't make any sense to do that, since the report's going to be exactly the same. The only thing that's going to be different is who signs it. Okay. Okay, CPA firm positions. Now this might seem kind of trivial, but there's actually a reason for it. And the reason is the AICPA does a lot of their rulemaking based on the level of someone in the organization. So there are different rules for, say, an associate versus a junior, or excuse me, a senior accountant versus a manager versus a partner. So those are the 4 categories. And the AICPA is so focused on those 4 groups that they will tell CPA firms, because sometimes a CPA firm might say, well, we don't organize that way. That's not the way we organize. We do something different, whatever it is. They'll say, okay, well, for everyone, every professional, in your group, every CPA in your group, you have to figure out which one of those categories, that they are most closely associated to. So even if you don't use their structure, they say you have to use the structure. You're going to, take your people and put them in somewhere in here so that you know what the rules are for those people. So even though it sounds a little bit, kind of trivial that of what, going through these, actually it is kind of important. Chapter 3 is all based on this, by the way. Just give you a heads up. Okay, staff assistants. These are entry level. And you basically are learning auditing. And they'll oftentimes rotate to different right here. Rotate to different audit responsibilities. And what I mean by that is, oops, is it spelled wrong? That's what I meant to say. Okay. What I mean by rotate to different responsibilities is that on one audit, you might be doing cash. Another audit, you might be doing inventory. Oops. And you do not need to be a CPA for this. Okay, so that's when you start out. They don't usually expect you to have any knowledge of auditing. In fact, they kind of don't want you to have auditing experience because almost all these CPA firms want to teach you their way. Every CPA firm is a little bit different. So when you go to whoever, Deloitte, when you go in there, they'll teach you the way that they do auditing, and that's what they expect. They don't expect you to come in with, gee, I know how to do auditing. They generally walk you along. Now, senior auditors, these are people that run the audit. These are the people that run the audit. They are they must be a CPA. The CPA exam is actually aimed at these people. So here's what happens when you come in as a staff assistant or associate. Sometimes they call them associates. When you come in, they'll teach you their way of doing auditing. They'll rotate you, inventorying that because they want you to become a senior. Now, you don't need to have a CPA license if you're a staff assistant, but if you're going to move up, you're going to have to take the CPA exam because you cannot be a senior unless you have a CPA license. And the CPA exam is aimed at the seniors. It's not aimed at the staff assistants because the answer to every question would be, well, I do what my senior tells me to do. Whereas a senior is actually the one who's making the calls. So they will actually, what I'm doing here, they will actually run the audit, and they must be a CPA to do it. So you need to pass the CPA exam if you're going to move up to the senior level. Managers. Oops. Oversee several audits and senior auditors. They are the main contacts for senior auditors. And they also must be CPA. Everyone after seniors got to be a CPA. Partners. They will obtain clients. They might also do oversee some of the audits. Usually they review audits at the end. But their big job here is to obtain clients. And by the way, that's for every partnership. It's obtaining clients. That's true for tax, partnerships. It's true for law firms. It's wherever there's partners, obtaining clients is the number one job. You could be a terrible auditor and be a great partner because your job is to get clients to come in. Okay, one other thing I want to talk about too is about how CPA firms kind of function. In CPA firms, it's either up or out. So, if you're an assistant, or associate, and you can't be made into a senior, you maybe don't pass a CPA exam, or they just don't think that you're right for the job, or there's no place for you. It's either up or out. So if they can't move you up, you're out. And the same thing for a senior. If you're a senior and they can't make you into a manager, you're out. Okay, so you don't have people in those positions for 10 years. There's a reason why you can't. I'll show you in a minute. So it's either up or out in a CPA firm. If you're a manager for a number of years and they don't think you can make partner, you're out. Now, usually it's not so bad because usually they try to get you a job with their client. So if you're an associate, you work for a couple of years for the CPA firm, putting in terrible hours and all that kind of stuff. If they don't think that they can move you up to senior, they're going to try to get you with a client. Maybe they try to get you an IBM. They'll call up IBM and say, look, we got this person. We can't, we just don't have a spot for him or her. And, we're wondering if you can, do you have any? And usually the client will say, yeah, send them over. CPA firms have a very strong reputation and people want to get people who worked in a CPA firm. They're hard workers, they're smart, they're, all these things that they associate with CPA firms. So even though you're generally, it's up or out, being out isn't such a bad thing. It's not unusual to get a raise and to get, much better working hours and all that kind of stuff once you get moved out. You start working for IBM. And another thing too, a lot of times they'll bump you up a number of years. 2 years in the CPA firm might move you ahead 8 years in your career. Is that fair or not? I don't know, but that's just the way it is. It might take you 8 years to become an accounting manager. You come out of a CPA firm, you've been there for 2 years, they might move you right into a manager position. So it is kind of a shortcut. The CPA firms are kind of viewed in the accounting world, right or wrong, that they're kind of like, it's kind of like the hot place to be. So anyway, and let me show you kind of why. Wait, I don't want to do that. Let me show you. I'm sorry, I'm learning how to use a computer here. Let me kind of show you why that is. It's sort of like this. Let me see here. So, you have all these different levels in the audit firm, and down here we have the associates or the assistants, and here we have the seniors, and here we have the managers, and up here we have the partners. And this is why any partnership, this is part of the problem. So if you're down here, let's say that they can't make you into senior, you say, well, why don't they just let you stay here? Why don't they just let you stay at that position? Let's say that you're a good assistant, you show up, you do your work, blah, blah, blah. Why don't they just let you stay there? Eventually, if you do that, these are all going to become plugged with people that can't be promoted. And if you run out of seniors, that's a problem. And it goes like that all the way up. If, you say, why don't we have the senior to stay here for years? Well, if they can't be made into a manager and they're a senior, it's going to plug that. You have to have partners for the partnership to survive. To do that, you cannot have people who cannot make partner plugging up these channels that will eventually lead to the partnership. So it's not that it's necessarily they're trying to be cruel or they're doing it to be jerks or something like that. It's just that a partnership cannot survive without partners. They have to have somebody bringing in clients, and you can't have people plugging those channels. About 1 out of 100, assistants or associates become partners. So you cannot have those blocked with people that can't get moved up, because eventually you're going to run out of well, not just seniors and managers, but partners. And then once you run out of partner, once no one's bringing in clients, there's nothing to do. Okay. Yeah, let's go over this one. Okay, American Institute for Certified Public Accountants. They make rules for, and it can be, and this one it can be A or B. They mostly make rules for A, but they can also be B in this case. And I'll tell you why I decided. Yeah, let's tell you why now. The AICPA, you say, okay, there's the PCAOB. PCAOB is the government agency. But they also, the PCAOB, one of the rules that they have for CPA firms is that they have to follow the AICPA rules when it comes to auditing. So, and only when they conflict with the PCAOB rules. So the PCAOB, while they oversee, they have a responsibility, they also say that you have to follow the AICPA rules. So the rules do apply to both of them. Probably most aligned with the non-issuers, but they actually do apply for both. Okay, AICPA, are they a government agency? Nope, very good. Okay, can they issue and revoke CPA licenses?
No.
No. Register CPA firms? Nope. Create the CPA exam?
Yes.
Yep, very good. Okay. Where am I at? Hold on. Okay, state laws. Many are based on the AICPA rules. Make laws for non-issuers. They actually do. And they make laws for issuers. And by the way, just because there are federal laws does not mean you don't have to follow state laws. So if you're IBM, if you're working in the state of wherever, Nebraska, you have to follow Nebraska's laws. You can say, well, we have government law. You do, but it doesn't change the fact you have to follow state laws also. Oops, what am I doing here? I did something stupid. Government agency. I'll give you that one. Yes, states are government agencies. Can they issue and revoke CPA licenses?
Yes.
Yep. They don't register CPA firms. I don't think I talked about that. We will talk about it momentarily. And they create the CPA exam. Nope. AICPA does that. They could. There's nothing stopping them from doing it. They just don't. And I doubt they ever will. There's no reason for them to. Okay, PCAOB. This is the Sarbanes-Oxley group. They make laws for who? I'll give you a hint. There's only one of these that they make rules for. Yep, issuers. They only apply to issuers. If you're Joe's hot dog stand, you can ignore anything that the PCAOB says. If you're IBM, you have to do what they say. As a government agency. They're actually part of this SEC. So yes, they are a government agency. Can they issue and revoke CPA licenses?
No.
Nope, they don't issue them. Now, they do register CPA firms, and I'll talk to you about that in a second here. And create the CPA exam. No, they do not. If you're going to audit publicly traded companies, you have to get registered with the PCAOB. They don't just let anybody audit publicly traded companies. So they do, if you want to audit, say IBM, you have to become registered with the PCAOB. They don't issue licenses, but they do register, and they register the entire CPA firm. So if you're Price Cooper's Waterhouse, they will register your entire firm to do audits of publicly traded companies. Now, because they do that, they also have quite a bit of power. Notice if you're a big CPA firm and they take away your ability to audit publicly traded companies, they took away half your business. So, they do have quite a bit of power over CPA firms because they must register with the PCAOB. Right. So even though they don't issue CPA licenses, they do have quite a bit of authority over CPA firms. Okay. Quite a bit of stuff here. Yeah, we'll go through this. This stuff's actually not too bad. What types of misstatements auditors look for? Material. And that is the only thing you're responsible to look for. Okay, misstatements can occur generally for two different reasons. An error, someone made a mistake, and fraud. What is the difference between those two? What's the difference between an error and a fraud? An error is a mistake, and what is a fraud? Yep, good. Fraud is intentional. So, fraud is intentional. And this is a very important distinction between those. So error, like you said, hey, I made a mistake writing mistake. All right, an error is a mistake. It's not intentional. Fraud is intentional. They meant to do it. And by the way, this in it being that it must be intentional. This is actually one of the things that's very hard to prosecute fraud. Because you must prove intent, which it sounds like it should be easy, but it's not always. Like, and a lot of times people, when they get arrested for fraud, they'll say it was a mistake. Oh, I thought blah, 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 whatever it is. So one of the really difficult parts about proving fraud is that it's intentional. There's a few ways to prove it. For instance, if somebody's trying to cover it up or something like that, it shows that they knew that it was wrong, that that it was intentional. But it can be very difficult sometimes to prove that the intent was there. It can make things a little bit tricky. Okay, type fraud. Type 1 fraud is financial statement fraud. The company called Cooking the Books. So this is when the financial statements are fraudulently designed, and they're usually fraudulent financial statements are usually designed to deceive somebody, to make the company look better than they really are. They can also be trying to make it look worse than they really are, but generally they try to make it look better than they really are. Fraud type 2 is got a hilarious understatement, understated term. Misappropriation of assets, also called employee theft. I just love that, misappropriation of assets. So if you misappropriate it, stick it in your pocket. Yeah, that employee theft is probably a better term for it. That's type 2 fraud. So type 1 fraud is when someone in the company is trying to cook the books, trying to make the company, usually make the company look better. They could be doing it for what they think is the right reason, maybe to get a loan or something like that, to get more investors in or whatever. They'll justify it some way in their mind. But it's when they make the financial statements look usually better than they really are. On the other hand, employee theft is when somebody walks in the company and is actually taking something from the company. So for instance, if I work for Walmart and I take something and stuff in my pocket, that's misappropriation of assets. I'm not cooking the books. I'm not trying to make the books look better or anything like that. But it is a fraud, and I am the employees are taking things. And by the way, which of those two as auditors are we probably more worried about? Are we more worried about type 1 fraud or type 2 fraud? Which fraud are we probably, oh, I'm sorry, you guys, yes, you're both right. Yeah, I'm sorry. Yes, yeah, we're really usually worried about this. And if you think about it, I mean, especially for if you talk about a larger company like Walmart, Walmart, I use the example of $5 million, we're not looking for $5 million, even if someone was to steal $5 million from Walmart, we wouldn't, I shouldn't say we wouldn't care, but it wouldn't be our responsibility to find it, and we wouldn't be looking for it. And so you talk about employee theft, I mean, how many Snicker bars I'd have to stuff in my pocket to make it, it'd be impossible, So a lot of times employee theft is generally, while it's possible that it could be large enough to be material, it's very unlikely. And it's much more likely that a company would be, to be material, we kind of cook the books rather than have somebody have such a fraud that's so material, that it would be, it'd come to be a concern of the auditors. Okay, compliance with laws, illegal acts. We're more concerned with direct effect laws, things like tax evasion are much more important to us than the indirect ones, which I'll talk about in a second, because they have a direct impact on the financial statements. So tax evasion will have a direct impact on financial statements. Why? Because those show that they owe less taxes than they really owe. That'll make their income look higher and so on. So if it has a direct effect, it's more important. Other laws. So let's say that they have some environmental law. So EPA violations. So for instance, EPA laws, maybe they violate EPA laws. Now, it's possible they get fined. But it's also possible that the EPA just tells them to knock it off, or, there's some negotiated thing or something. So a lot of times, even though it is breaking the law, and you don't know whether it's direct or not, as far as what it might have on the financial statements. Tax evasion is direct. It's more important because it will have a direct impact on the financial statements, whereas EPA violations may not. And it's not to say, it's not to put a qualitative that, oh, it's okay, it's okay to do EPA, break EPA laws or something like that. It's something that we're reporting on the financial statements. So if it doesn't have a direct impact on the financial statements, and there is no, it's hard to tell what the financial impact would be, we're less worried about that than we are, say, those things that have direct impact on it. Responsibility for detecting illegal acts. Only material. It's the same as anything else. So if someone is guilty of doing a immaterial illegal act, we really don't care. Maybe we care, but it's not going to be, if it's not material, it's not going to be in our audit report. Okay, responsibility for reporting illegal acts. This is a can of worms. I'll get into it, I guess. Okay. I said report material. Okay, so report material illegal acts to upper management and the board of directors / audit committee. If they have on either one. Okay. I should say to the clients. Okay, so you report it to illegal acts, the client's upper management and the board of directors. No action is taken by the client. This becomes a problem. If it is a non-issuer, here. Here's the problem with a client doing illegal acts. You have a fiduciary duty to the client. It's confidentiality. Now, notice when they're doing an illegal act that you know, people say, well, you just go to the police and you file a report. You can't do that. You can lose your license for doing that. So you got to get a lawyer because you're in kind of a Netherlands of duties. You have a duty to the public as a professional. You also have a duty to your client, and that client is confidentiality. So if you go through IBM, if you do an audit of IBM, there is a confidentiality that you don't share information with anyone else that you come across. You get the information you need to do your audit, and you document it and all that, but you don't share that with anyone else. So you're kind of stuck. You know, here you have them doing an illegal act, they're not acting on it. So if it's a non-issuer, you generally get a lawyer and see what your options are. And it might be withdraw from the audit. It could be in certain circumstances, you might be required to report it depending on what it is. But yeah, so I know that's not a very good answer, but that is basically what you have to do if you're a non-issuer. Now, if you're an issuer, you have a little bit better. If you're an issuer, you are on a much better ground. It must be reported to the SEC within 24 hours if no action is taken by the client. Now, the reason for this is they want the client to do something. If the client doesn't do it, then you'll just tell the client, okay, I got to tell the SEC about this. And it basically has to be done today. If you don't report it within 24 hours, not only is the client in trouble, but so are you. So it must be reported. You know, there is no, gee, I wonder if I should. It must be reported to the SEC within 24 hours if no action is taken by the client. You guys can't see my screen. I am an idiot. Hold on. I am so sorry. How long have I been going on without the screen on, by the way? A really long time?
It goes in and out.
Oh, sorry about that. Anyway. All right. Well, so you must report it within 24 hours if no action is taken. I used to have the excuse, well, I'm not used to doing these. I've been doing them for 3 years now. I don't have an excuse. So if no action is taken, non-issuer, you got to get a lawyer because you have this fiduciary duty. You have a fiduciary duty of confidentiality. And you still have that fiduciary duty to your issuer, but the SEC says this is more important and you got to tell us about it. Now you still can't just go giving out their information to anybody, but yeah. let's stop here. I'm gonna stop here. And we will pick this up next week. So I'll change the due date on this. There's a couple things I want to do next week anyways that will. So let's stop right there. And we'll get into the types of audit reports next week. So nothing is due this week. One thing I should tell you guys, and that is that tomorrow morning I'm getting my hip replaced. The Olympics is now having breakdancing, so you know, that'd be a good time for me to do that. So anyway, the only reason I'm telling you this, there should be no problem with this class. I should be fine by next Monday. But if you email me like in the next couple days, I probably won't return it. I may not even be home to do that, or even in the hospital. Regardless, and if you call my phone, you're probably going to get my son. But anyway, so for the next couple of days, if you email me and I don't return it, it's probably because of the surgery. But anyway, it shouldn't affect this class, and next week it should be fine. So just to let you know. All right. Any questions? So nothing is due this week. Nothing is due this week. I will record who showed up for the class, and I'll give you guys extra credit points for that. But nothing is due this week for this class. And next week we will finish up the handout and do a couple other things, and then yeah, go from there. Any questions? Oh, thank you. Thank you. Yeah, it shouldn't be too bad. It's kind of actually I had a hip replaced before, and I was in the hospital for like a week. They're going to release me the same day. It's a much different operation, which is good. But thank you. Thank you. Okay, so nothing is due for the next week. Okay. All right. Have a good evening, and I will see you guys in a week's time.
Thank you. Good luck.
Thank you.
Thank you.
Thanks.
Hello, Professor.
Thanks.
I do have a question.
Yeah.
So you said that we don't need the book for this class, the ebook Connect?
Well, you can use any form of the book you want. It doesn't have to be an ebook. You might be able to rent it. It's been out, I think, a couple of years, so you might be able to pick it up used or rent it for much cheaper, and that's fine. You don't need the electronic. You don't need the Connect, but any form of the book, and it's a good book. It's and if you do take the advanced auditing, if you have me anyways, you don't need to. It's the same book.
Right. Okay. Yeah, because I thought we needed the Connect version of it because I know that some accounting classes we had to submit our homeworks in there for that reason.
And that could be the case too. If you go into it's advanced it's practice, I think it is what you call it, the practice of auditing. You might have an instructor that insists on you having it. If you have me for 433, it won't be. But I don't require it. And quite honestly, the reason I don't require it is because a lot of times it's just simply people typing in, filling in the blanks anyways. It's not the same as some other class where it may have a drop down and you have to put in the account or the number or something like that in normal accounting.
Right.
But auditing is not like that. You can see it's just, the class is basically similar to what we're doing now. I mean, it's a lot of this, but not that, and that sort of thing, kind of logic.
So a lot of the homework we would turn in through Blackboard. It wouldn't be like the Connect electronic version of it.
Correct.
Okay, got it. Okay, thank you so much, Professor.
Anytime.